the net expectations, which is the difference between people expecting an increase in stock prices and an actual decrease in stock prices, is the lowest that we've seen since 2010. So when people are anticipating something, they usually prepare for it. And in this instance, they usually become more defensive in their portfolios. And historically, that tends to be a good thing, particularly if with your narrative, Neil, the Brexit potential that it's not a disaster takes hold. I think that becomes pretty interesting.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script. We're open to discuss markets, economics, policy, history, and life. It is the 28th of March, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. You can hop over there and see the things that we're talking about. If you're on the screen through YouTube, certainly hit that subscribe button as we keep building this channel and gaining followers. I don't know what to start with, Steve. I mean, let's talk real briefly on this Signal Gate, the Signal saga, whatever it is. Certainly a mess. I mean, it's pretty political, so I think there's a lot for us to discuss there other than a pretty big stubbing of the toe, I would say, in terms of right out of the gate. Is he going to cost Waltz his job? Should it cost Waltz his job? The one thing that I would just, point out, I think, from both sides of the aisle, if you're okay with Hillary's server, then you should be okay with this, and we weren't okay with Hillary's server, or a lot of people weren't okay with Hillary's server, then I don't think you should be okay with this either. And frankly, as much as anything, for having these technology barons in the or at least in the periphery of the White House, you certainly would think that we could have a secure, maybe government encrypted system for texting, but it did come off as fairly juvenile, I would say. It sounded like some kids cheering their local high school football team. What's your take on it? What are the ramifications here?
Well, I think you're right to point out the hypocrisy, where, both parties are now on opposite issues compared to where they were during the Hillary Clinton Servergate issue. I think another thing to point out, too, that probably angers a lot of folks is we've seen this, again, on both sides, is there's a different standard for those at the highest levels than it would be if you were at a lower level, because you would probably be dismissed from your job if you had a security, or at least have your security clearance removed if you were in a national security setting. There's a debate, and it's going to be sort of viewed through a partisan lens as to whether or not the material being shared was classified. I think at the minimum, it's sensitive. Look, at the end of the day, Waltz shouldn't have added somebody he wasn't completely sure of. I don't know that his story stands up where he's saying that he doesn't know Jeffrey Goldberg. Well, if you didn't know him, why did you have his number in your phone? I mean, that's sort of, at this point, we haven't really gotten a great explanation there. And look, you shouldn't be sharing operational security sensitive information in a forum like that, particularly a commercial app. So I think the reason the stories continue to have legs is because, if you're President Trump, you typically don't like to admit a mistake. You sort of use it as a sign of weakness. I think that filters down to some of his cabinet officials. I think Trump's probably reluctant to remove Waltz right away. I think over time, we'll see, or whether just sort of let the story move on and maybe a few months down the road. I think for Pete Hegseth, clearly he's somebody who a lot of Democratic news outlets had a target on him heading into his nomination. He was a former Fox News contributor, so it's not surprised to sort of see them look for opportunities to take shots at him. But you can only take so many shots at this point. So I think it's something to watch moving forward.
Yeah. All right. We'll get off of that and let's talk about the real issue at hand for both economics and from a policy perspective, which is tariffs. We've got this looming deadline. We talked a little bit about deadlines last week. We certainly looked into that, and deadlines actually tend to be pretty bullish for markets. So let's see what happens. Neil, you had I think a good quip. I hope it was attributable to you, but you talked about tariffs, don't think about tariffs as an on-off switch. Think of them more as a dial. Why don't you unpack that a little bit for us?
Well, sure. I think the idea that Trump is going to be done with this, I think, is a bit foolish to believe that. I mean, from what we've seen, everything is a constant negotiation. So actually putting tariffs on the back burner for good, I don't think we should expect that. I mean, think about USMCA, right? I mean, it hasn't even been 5 years that thing's been enforced. Trump hailed it as like the greatest thing ever, and now he wants to renegotiate it. So it makes it challenging, I think, for someone sitting across the table to know whether like any deal is actually final, if everything is an ongoing negotiation. So that obviously creates difficulty for business planning. But I think something more simplistically, right, Jeff? This is what he believes. Okay, like I think people just need to get that through their head. Like he believes trade deficits are bad in and of themselves. I don't want to get into a long, extended conversation about why I think that's not really the right way to think about things, like especially on a bilateral basis. But that's what he believes, and so I think it makes sense for people just to assume that there will be times where we have a period of calm in the markets where we don't have to necessarily worry about trade. Maybe they'll be focusing on other things like getting deregulation or more growth-friendly legislation over the finish line. But then there will be other times where maybe there's like a lull in the news flow, and let's talk about trade again. Let's put the pressure on this country or that country. This is in my opinion, the core part of his political identity. It's been the one thing that he's always talked about. He's a trade protectionist. He believes in mercantilism, right? I mean, so I don't think it's over. Like he really believes in this stuff. And, that may not be the case for some of the other issues that he ran on, but I think with respect to trade, there's no doubt that, protectionism is something that's deeply embedded into his ideology.
Well, he's had a long history of that, right? Going back to the 1980s. I mean, he's talked about that and the gutting of Middle America, basically, and
or even like Japan, right? Like Japan and cars, and they dumped their electronics on us. I mean, look, what was interesting about that is that he was talking about that at a time when Milton Friedman had a special on CBS. I mean, I think on PBS, talking about what was it, the capitalism and freedom, talking about how it's important to reduce trade barriers. So it's an interesting kind of juxtaposition about what his views were in the 80s versus what was actually happening on the 80s when we were sort of making a push towards more liberalized trade, liberal, smaller case trading relationships across the world. So look, as I said, I mean, he believes in this, and I mean, in his mind, right? Just put yourself in his shoes. He survived an assassination attempt. I think that gives him, at least in his own mind, like a sense of moral righteousness to what he's doing. And for people that are concerned about what is the strike price on the Trump put, do you think there's a level of equities that would get him to back off on trade? No, I don't. I think the short-run dislocations in the markets and the economy are sort of secondary into his thinking. He wants to and think about it, right? If you really want to reindustrialize and you're going to use tariffs as a way to do it, it can't be a negotiation. You have to keep it on permanently because it takes time to build out the capacity to reindustrialize. So, I mean, the one thing I will worry about, and I'll let Steve take over, is one thing I think about is like, what if it's actually not the disaster that people make it out to be? Like, I don't think anyone's talking about like sudden stop dynamics with respect to this trade policy, right? Like, what if it's not? I mean, it's a short run hit. It's not pleasant, but a year from now, after the tax laws put in place, maybe there are some deductions for people allowed to like write off your car loan. I mean, I've been hearing about that. So there may be some offsets to what he's talking about. Like, what if we're growing off of that? Like, are we going to be really thinking about like the potential longer run productivity dynamics? Are we just going to be thinking about, okay, things are improving, maybe interest rates are somewhat lower? I just go back to like the Brexit situation, right? I mean, everyone was like, "Oh my God, they did it!" And then all of a sudden, like if you recall, like markets were basically back to highs like in a week. And not only that, politically, like they kept electing in conservative governments over there. So anyway, I don't know. I mean, it's neither here nor. I mean, I just think it's like something to think about. If you're like a market participant, I mean, do we just snap back like after all of this is over? Something to think about.
Yeah, well, and with your
it's not a financial event, clearly, right? I mean, that's I don't think.
Well, and the markets will figure it out pretty quickly. And I think what they've done is, other than some targeted industries, they've really held up pretty well. Steve, walk us through the nitty gritty. I mean, we're within a week now of this. What are they calling it?
Liberation Day.
Liberation Day, right? So walk us through. Obviously, there was a little bit of maybe a preemptive strike, if you will, in autos. You had an interesting take, which was, talk about it as it relates to the troublesome nature of our text communications.
Well, we had Liberation Day on Wednesday, and you sort of what was going on this past week, and you had, I think, three things that sort of jumped out at me. One, you had Trump announce 25% tariffs on any countries that import oil from Venezuela. I don't know that people are necessarily expecting that. I don't know that should necessarily be a surprise. You also had Trump sort of suggest that he's going to accelerate the timeline here with respect to copper tariffs. That was something he used a Section 232 authority. According to the announcement, there's going to be 270 days for the investigation to be conducted. But again, Trump's sort of trying to accelerate that. And the 232 is interesting because that was sort of the same authority he used with respect to the auto tariffs announced on Wednesday. And the interesting thing, when you think about the effective date for these tariffs, for the auto tariffs, it's going to be Thursday, April 3rd. And for the tariffs on importers of Venezuelan oil, it's going to be on Liberation Day, Wednesday, April 2nd. So, there's a couple of schools of thought here as to why is Trump doing this, announcing these things now ahead of this reciprocal tariff date. And I think it's notable that, when you had Trump at the signing ceremony on Wednesday for these auto tariffs, he was sort of talking down the reciprocal rate, saying that, he thought people were going to be pleasantly surprised. And this might, I guess, lend some credence that maybe the Trump administration is being successful in getting other countries to reduce their interest or their tariff rates, rather than, I think, the prevailing view a few weeks ago was that the U.S. is going to be forced to raise the rates. So I think that's going to be an important thing to see on Wednesday. Are the rates actually lower than many people are anticipating? You have to remember too that I think there's about 15 or so trading partners that the Trump administration is really focused on with these reciprocal tariffs. They may not all respond the same way. I'd be surprised if they're not sort of coordinating amongst themselves to, sort of see, hey, how are you guys sort of approaching this? What was your conversation like? So, I think that's important because if all 15 countries or trading partners are being difficult, then it's going to be really hard for the Trump administration to sort of pick 15 simultaneous trade battles and really escalate things. Whereas, look, if you get 12 or so, 13 or so in your favor in terms of reducing their rates, if you have a few holdouts, maybe the European Union or Canada, you might be able to be a little more aggressive on them moving forward. I think the market is hoping for some more greater certainty on April 2nd. And I think they'll at least have whatever the rates are. I think the thing to watch is going to be, when do those tariffs take effect? I think that's one thing to look for. The other thing too is, how are these other countries going to respond? I would agree a lot with what Neil said, that Trump likes tariffs. I think he views them as a way to force countries to the negotiating table, but not just countries, companies. I think with respect to the auto tariffs, this could be something where, Trump's sort of saying, you guys need to come here. You need to make some big investment announcements. He likes trotting out companies that do that. And would it surprise me if they did that maybe some of these auto tariffs could eventually be, dialed back or further extended? I'm not sure. But again, that really wouldn't surprise me. And maybe he's being more aggressive announcing some of these things now this week, knowing that next week he may be sort of perceived as being soft if those tariff rates are lower, because you got to preserve your credibility. Because to Neil's point, tariff threats with Trump aren't going away. He'll look for times when he can dial up them, as Neil said. I think there's probably be some political dynamics. I'd be surprised if he's doing that, say, like the months heading into November 26 midterm elections, and you got to work your way back from the 28th presidential election. I don't think Trump's running again, but I think his political legacy may be very well defined.
Well, that's a relief because he's not supposed to be able to, right?
Well,
yeah. I will say, though, like these announcements, while they're kind of like, the sort of pomp and, but let's be clear. I mean, that is not how you solve you can't solve the trade deficit really on a bilateral basis, right? You can't do it with like negotiated deals with this company or that company. The trade deficit is primarily a function of, lack of consumption overseas and, an imbalanced sort of private economy where you have a little bit too much consumption in the US. And, that's if you really wanted to solve the trade deficit, I think you have to address those underlying issues, not create deals here and there. Which is why, frankly, the focus on China makes a lot of sense. And, to some extent, Germany too. That's another country that doesn't spend enough. So it's welcome that they're spending a little bit more on their defense. But it also kind of calls into question, as I've said, why do you have to go after Canada? Why do you have to go after Mexico? Having like a unified trading bloc. Remember, I will say, before we go to the next topic, America itself, right, is an exercise in free trade. We are one massive free trade zone, right? And so if you think about, like if all the goods and services that, that are for people in New York should only be produced by New Yorkers, and we shouldn't outsource any of those jobs to New Jersey, should all the jobs, for New Jersey be in New Jersey too, right? And if you think every state had their own trade barriers, do you honestly believe that we'd have greater prosperity? Like that would be like, to me, like the easiest defense of free trade. And so, Trump talks about Canada as like the 51st state, from a supply chain perspective, guys, they kind of already are.
Yeah. Yeah. Well, I was just going to say, in the last 100 years, has it never been uttered that people are relieved that Germany is rearming themselves?
Well, that's the other thing. That's the other thing. Right. Yeah, that's the other thing, right? Everyone's sort of like hoped up on Europe, right? You've been talking about like European flows and all this. At some level, right? It's like you're trusting the Germans to get it right. And haven't they? They've kind of been getting everything wrong for the last 2 decades, I feel like, between like Merkel's debt break and like energy policy, you can make an argument about migration policy. Like, what have they gotten right in the last 20 years? So anyway.
Well, we're seeing massive inflows there, which look unsustainable, frankly. So from a tactical standpoint, we actually think Germany is a fade from a market standpoint. But they have improved their relative trends to Europe, so that's good news, not bad. Neil, let's talk about the economy, and let's talk a little bit about the decline. And people push back on this, but it is true. You can see it in the data. The people that are pushing back are certainly politically motivated. We've been seeing a decline in the data really for the last 6 months or so. I think that was made more apparent this week. You want to touch on some of those data points, the trajectory, and then when do you feel like it's going to start hitting employment, or is it not? And if it's not, why not?
Well, I think it will. I've sort of said that we're kind of in like frog boiling in the pot territory with respect to the labor market. But I do think that look, a bad situation has been made worse, arguably. I don't want to absolve the administration, but I think it's also true they were dealt a fairly weak hand. People are looking at the economy at the surface level and saying, "Yo, look, he inherited this great economy." No, what he inherited was a very deeply imbalanced economy. Okay, for example, in the fourth quarter, non-residential business fixed investment fell. It contracted outright, led by declines in equipment and research and development spending. Now, you can say that policy uncertainty is making that worse, but it's also true that in Q4 things were already quite weak. the consumer spending outlook. Over the last 3 months, so that's December, January, and Feb, before any tariff stuff, really, real incomes net of transfers are up barely 1% at an annual rate. And consumer spending has been slowing. Now, last year, we had very strong growth in consumption, and we had a big drawdown in the savings rate. So even if you assume the savings rate was going to be stable, we'd have weaker consumer spending, right? In other words, some slowdown was inevitable. Government spending, right? I mean, that's something that the administration has been talking a lot about. We've had a lot of sort of support from government. Well, government spending and investment added about 0.5 percentage point to growth in Q4, with a lot of that coming from state and local governments, which we know are getting worse, not better. They exhausted their pandemic relief money. I mean, you see the headlines: Chicago's transit, almost $1 billion in the hole. LA is a wreck. I mean, they're talking about layoffs being inevitable. And then the housing market's been frozen. That was true before. It's still true today. I mean, it's very difficult to make the math work if the labor markets are slowing. You can't really afford a 6.5% mortgage rate if you're most people. So some slowing was inevitable. And so, just to say things were just hunky-dory, I think, in December is just, look, I mean, I can't stand the people that say it was all good up until a month ago. Gene Hackman was all good up until a month ago too.
Oh, Jesus.
Right. I mean, it's just, but it's the same energy with that argument. So I don't know. I mean, I think, things were worse. I think people are trying to say he was dealt a very strong hand to make a political argument. And I think, I think the administration probably could have done a much better job, talking down the economy on their way in the door. That probably would have saved them a lot of grief. And yet what we've seen is more of this, that good data point is us, that bad data point is Biden. You can't have it both ways, kind of. So but what I'm basically saying is the fact that things were somewhat more sluggish than people appreciate going in means that there was less of a buffer for them to do what they've been trying to do now.
Right. And so when you look at that, why do you think the employment will get worse, and how much worse do you think it's going to get? I mean, obviously the trajectory suggests it's going to get worse. Why haven't we seen it get worse yet? And then where do you think it finally troughs out?
Well, so I think it has been getting worse. I mean, if you look in the right places, if you look at total income growth, right? So if you take the sum product of jobs, the work week, and hourly earnings, I mean, that number has been slowing, right? So when you look at private wages and salaries, I mean, they're barely up 3% over the last year. I mean, that's a very weak number on a nominal basis, right? That's well below where the federal funds rate is. So when you're talking about compensation growth running below the overnight Fed funds rate, I mean, that's a problem. That's a sure sign of tight monetary policy, which is where we are right now. In terms of where it could go, I mean, I think the unemployment rate's going higher. I wouldn't be surprised if it's rising a tenth, every couple of months, between now and the summer. And I think ultimately that'll bring the Fed in to cut interest rates. The pushback I think that we get for that is basically, well, what if, the labor supply isn't growing as rapidly because of immigration? Okay, I mean, but even if, let's cede that point. I mean, I don't know that it's true. I think demand is weak enough that the unemployment rate probably does go up. I mean, we're still talking about, at the end of the day, below potential growth, right? So if you have below potential growth, you should see higher unemployment. That said, even if immigration is slowing and that kind of lowers the break-even level on the labor force, that would still mean that nominal incomes would slow down, which would still mean that policy would be too tight relative to the economy. Yeah, I mean, I think things are, the labor markets are deteriorating. I mean, people talk about job cuts and DOGE, but, what about retail bankruptcies? And, I mean, you have more C-suite people being laid off. I mean, that's kind of the headlines out of companies like Southwest and Starbucks and the financial industry. I mean, it's kind of different than 2022 when it was all centered in tech. Now it's a little bit more broad-based, the layoffs at least.
Yep, for sure. Well, we both had a chart. Mine from a sentiment perspective, yours from the economic perspective, but same message, which was from the conference board. And we should talk about that a little bit. You go first. This is my version of the chart, but this is essentially the expectations of stock price increases versus decreases. We found this years ago. The series obviously goes back to the 1980s, but typical fashion, this tends to be a contrarian indication. What's your read on this, Neil?
Well, people were like pretty optimistic right after the election, and then we've seen sort of a nosedive. To me, it's basically you've said this before. Like, price has a habit of leading the narrative, and so you saw a decline in equity prices, and lo and behold, like that washed out a lot of sentiment. And so, typically, when you have net pessimism, it's usually a good sign for a lot of the negative news to be priced in, right? So in other words, a lot of the people that wanted to sell have sold. And so the only people left are people to buy. And that's ultimately what drives markets up.
Yeah, for sure. The thing that stood out to me is that T-stat, which is a negative 2.5, which just says to forward returns, anything that's below -2 means it's a statistically meaningful contrarian indicator. In other words, the lower it goes, the higher your independent variable goes. In this case, equity prices. So, pretty solid on that footing. The expectations for lower stock prices is extraordinarily high. The net expectations, which is the difference between people expecting an increase in stock prices and an actual decrease in stock prices, is the lowest that we've seen since 2010. So when people are anticipating something, they usually prepare for it. And in this instance, they usually become more defensive in their portfolios. And historically, that tends to be a good thing, particularly if with your narrative, Neil, the Brexit potential that it's not a disaster takes hold. I think that becomes pretty interesting. Well, it is time for this week's mailbag, and you might see a similarity in our mailman here to that of one of our panelists. And it's not you, Pavlik. Let's put it that way. But it is. He might be chunky enough to be me, Neil. Sorry, man. I should have done the slim version for you, but.
Is that like I don't know? Is that guy does not look like of Indian origin? He looks like actually more Mexican. But anyway, whatever.
How do you want to test for that? I can't do the DNA. How do you want to test for that?
Well, the other thing, of course, is that the cowboy hat's got to be you, right? Like, so this is like AI, like doing a mashup of Jeff and Neil, right? Like, I wouldn't be caught dead wearing a hat. Look at these luscious locks, right? This
is AI gone wrong. This is what happens.
AI is doing a Jeff and Neil mashup. But don't worry, Pooja and Lynette, we're not trying to have a baby anytime soon. So,
This is right before it all goes off the rails. This is the leading indication of AI taking over. All right, well, let's bring in our own mailman. So the accent's going to be a little different than the visual here. But Harry, what is our mailbag question this week?
Can I use my Taiwanese English?
There we go.
All right. We have the question come from Monish Ball today. I know right now both the administration and the Fed are sounding hawkish, but do you think a put exists for a certain unemployment percentage, jobs number, or S&P value? Thank you.
All right. Good work. So the question is, both the administration and the Fed are sounding hawkish. Do we think that a put exists for a certain unemployment number, jobs number, or a S&P value? Neil, I'll kick that to you first in terms of the unemployment. What do you think?
Well, I think I think number one, yes, there's a put. I think the first order of business is to understand that the strike price on the Trump put is substantially lower than the strike price on the Fed put. I don't think this is like 2018, where like a 5 to 7% correction in equity markets gets Trump to back off a little bit with respect to his trade rhetoric. I mean, he's not going to face the voters again. And, as I said, I mean, I think, there's like a moral righteousness in his own mind to what he's doing now that there may not have been before. He felt like he was sort of talked out of it last time, and now he's got the opportunity to really push forward with it. So I think the strike price is much lower for Trump. I mean, when he talks about things like, you may have to bear with me for a little bit, I mean, that's, that to me is a pretty important tell. For the Fed, they have an obligation to maximum employment and price stability, right? And so for them, I think that there is, a level that they will come in on. I mean, look, they have the unemployment rate going to 4.4% by the end of the year. If you're there or you look like you're getting there by the middle of the year, guess what? They're going to start cutting sooner. They're going to pull the rate cuts that they have baked into 2026 into 2025. So that would mean 4 for the year. That's kind of where I'm at. I mean, I think that they'll basically wait for another couple of months. You'll start to see ongoing weakness in the economy and upward pressure on unemployment, and that'll bring the Fed in to cut interest rates starting sometime this summer. And we see them going 4 times. That's more than where the markets are at, obviously. But I think that's kind of it's sort of a delay, and then kind of get on the right side of the 8 ball and get it going.
Yeah, I would say that similarly, it's going to be very hard for the Fed just to do it with equity prices. Now, the challenge always is equities are pretty good at leading that data. So if that data is going to be weak, equities are ahead of that. Right now, as we see it, the trends are still positive for the S&P. They have deteriorated, no doubt about that. We have seen that trend deterioration. We've actually seen a trend reversal in small caps. So that's important that we are seeing the lower tiered names actually deteriorate. So that's an important observation here. But in terms of large cap, mega cap names are still they're still okay. If we rally back. We think we're going to rally back to the 50-day. I think that's pretty easy, frankly. If we get up there, we don't have expansions in 20-day highs. We don't have expansions in the percentage of issues above the 20-day moving average. Then that's going to start to call into question some of the distribution that develops in markets, usually as you're creating a top. And if that rolls over from there, if the 50-day, which is now declining, actually ends up being pretty formidable resistance, then I think we have a bigger problem on our hands. But that's likely the second half of the year, not right here, and certainly not in what we think the next quarter because of the oversold condition and the extremes in sentiment. So we'll continue to watch that. Steve, what do we got next week in terms of what's happening in DC?
Well, obviously, outside of Liberation Day, a few things would point you to. Tuesday, you're going to have 2 elections in Florida to replace seats that were formerly held by Mike Waltz, who's now the national security advisor. Talked about him a little earlier, as well as Matt Gaetz. They both stepped down from the roles, and the seats should be relatively safe for Republicans. They have a large number in terms of registration, and Trump carried the seats pretty comfortably. That said, polls, particularly in the Waltz seat, suggest that race is closer than it should be. And Democrats are spending a lot of money. I think it's about 10 to 1 compared to Republicans are right now. And that is going to serve as sort of an early barometer on the mood of the electorate in response to Trump's first couple months in office. Other races to watch, there's going to be one also on Tuesday. It's a Wisconsin race for a state Supreme Court seat that's going to control the composition of the Supreme Court there. So I think that's important to watch. And then we're going to have gubernatorial races later in the year. I think Virginia is probably the better barometer there. But these election results and the exit polls are going to influence Republican lawmakers. And so I think that's sort of a thing to watch. I think the watch is going to be probably later towards the week. Senate Republicans want to move forward on a budget resolution. They're waiting for a ruling from the Senate parliamentarian as to when they can, as if they can use a current policy baseline. And that would basically prevent them from having to score an extension of the expiring Trump tax cuts, about $4.5 trillion, according to the Congressional Budget Office. And that would be a deviation from current law. And that's sort of why that is important, because not only would you have potential additional supply of treasuries needed to, that could be adding to the debt. I think the more important thing is you'd be removing a precedent that sort of acts as a fiscal restraint on some excessive spending. And I'd put maybe 25% chance that the parliamentarian actually allows this. But if she does, watch the bond market, because I think once they wake up to that, they might not be pleased with the move, which could limit Republican aspirations around the reconciliation package. So those are the two things that jump out at me. And then for you, I think next Saturday, April 5th, is when the TikTok ban has been extended to. So we may see another extension there. I know you on pins and needles on that, but just wanted to.
What am I going to do with my free time? What am I going to do with my free time?
We'll probably get another extension. So, but we'll see.
I'm going to write my congressman. Neil, what's going on next week? Big week.
It's a big week. We are going to get jobs data. First, we'll get JOLTS. That'll be for February. And then we end the week with the March employment report. Market right now is looking for 125,000 on private payroll employment. I'll be keeping a particular eye on the work week. I mean, the work week has been quite sluggish of late. I mean, it hasn't really moved. That's the number I'm keeping a particularly close eye on. Market right now is thinking it goes up 1/10 in March. If that happens, maybe you start to see some slowing in wage growth. Usually, sometimes those two go the other way. We'll also get data ISM manufacturing. The S&P Global manufacturing PMI did kind of pull back into contraction territory, I believe, for March. So we'll see what the ISM shows. But, the fact that, tariffs are happening, I mean, that's probably weighing on the sentiment of manufacturing purchasing managers. So, look for some slowing there.
Well, we're going to watch our market cycle clock. We'll update that next week with some of our data collected throughout the month. And look, we're still looking for that bounce. We think deadlines actually tend to be bullish, not bearish historically. They're noisy. There's no doubt about it. They're noisy, but the sentiment setup we think is bullish. The trends are still in place. We had a good internal and external oversold condition. That should give us at least a tactical rally, again, back to that 50-day. And then the characteristics of that rally will be very important to see what the durability, whether it's a resumption of the trend or a potential top formation. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and YouTube. Hit that subscribe button. I'll get better with this production on our end. But until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
We'll see you.